So you want to buy rental properties, but you either A, have horrible credit, or B, you don't want your credit being affected at all. Hey, what's going on, guys? This is Daniel, one half of the Kwok Brothers, and I personally have bought single-family homes, fourplexes, 8 units, and even large apartment complexes using none of my own credit or actually even none of my own money. And in this video, that's exactly what we're going to talk about: how to buy rental properties without using your own credit, or possibly not even having your credit be involved. But before we go ahead and get to that content, guys, please subscribe to this YouTube channel. And again, share it as much as you possibly can if you want. We're actually gonna have a lot of videos related to real estate investing in the future and also the past. So if you guys subscribe, you'll actually be getting a lot more information about real estate investing beyond just how to buy properties using none of your own credit or actually even none of your own money. So pretty much here's how I got involved in real estate. Because I'm sure you're asking, well, Daniel, how did you do it? How did you buy rental properties without using your own credit? Well, truth be told, guys, I actually didn't have a choice, right? So let me take you guys back about 6-7 years ago. And I know for a lot of you guys that may be a little bit more seasoned in life, I'm not gonna use the O word, but for those of you guys that may be more seasoned in life, you guys are maybe thinking, oh my gosh, you're so young, you're a baby, you're a kid. I know, guys, I get it all the time. But let's go back about 6 or 7 years. I was actually 19 years old, and this is actually around the time I first got into real estate investing. At the time, I had negative $187.65 in my bank account. I had a maxed out credit card. I mean, financially, I just was not in a good place, guys. And maybe you're watching this video and you're in a similar place. Well, good news is if you are, well, I have a solution for you. And if you're not, that's okay. Because, well, if you can actually use the strategies that I used when I was in this situation, you can actually do it without actually being in that situation. So that's where I was. I was 19 years old. I had negative $187.65 in my bank account, maxed out credit cards. One day I heard about this real estate investing thing. And well, how did I hear through it? Well, I was actually online. And for those of you guys that don't know, I'm a huge and diehard Chicago Bulls fan, right? I love the Bulls. I go to a lot of different games. And I know you guys might say the Bulls are sucking right now. And yes, they are. But you know what? We're rebuilding. That's exactly what we're doing. And well, my dream ever since I was a little kid was to actually one day be the owner. So just like how Mark Cuban is for the Mavericks, I wanted to be that for the Chicago Bulls. And I did a little research on who owns the Bulls right now. And it's this guy named Jerry Reinsdorf. And I Googled, what did he do? You know, how did he make his money and how did he make his wealth? And I Googled that he's actually a CPA and an attorney, but in his late 20s, he started investing in real estate. So I was like, oh man, that's exactly what I gotta do. So at age 19, I started looking around, and my brother one night actually dragged me, and I kid you not, dragged me to this seminar. And I was like, oh boy, here we go, right? And we sat down, and for once in my life, guys, and I don't know how much you guys know about Sam and I's background and upbringing, but we weren't rich exactly, right? Matter of fact, we were the complete opposite. We grew up with a lot of different financial hardships and difficult times, you know, especially for our family. And for the first time in my life, as I sat there in that seminar, you know, whether it was a quote unquote scam or not, whatever it may be, you know, it doesn't matter. The most important thing that night was I realized why my family was the way we were and why other people drove around in Lamborghinis, Porsches, and Ferraris. And no, I didn't go, well, it's all the system's fault. If the government would get their act together, no, obviously, right? I gotta focus on the things that I can change as opposed to things on the outside and the external. So I finally figured out why. I started learning that, you know, people who make money, who invest, they think differently, they act differently, and they put their money and they're wiser and they're better stewards of it a lot of times. So I started learning about real estate investing. I started, you know, studying my butt off, and I would wake up at 7 a.m. and go to sleep at midnight. And the whole time I would be focused on learning how to invest in real estate. So I studied. And unfortunately, there was one day where I had a conversation with a commercial lender. And there was this commercial lender amongst a community of people that I saw, you know, once a week. And I had a conversation with them, and I was so excited. And by then, I had learned a good amount. I watched a lot of YouTube videos. I bought a lot of different courses. I read a lot of different books. And I was a pretty confident guy in my knowledge of real estate investing. But of course, I still haven't done a single deal. So I was talking to this lender, trying to pick his brain and trying to learn more. And by the time I got into the 15th minute of the conversation, I think, you know, I was extremely disappointed. Now, why was I extremely disappointed? Well, I was disappointed because this commercial lender pretty much said, listen, you're 21, 22 years old. What bank is gonna give you a loan? It doesn't matter how much you know about real estate investing. You literally have zero net worth, you have no money, and your credit is horrible. I'm sorry to tell you, but you're never gonna do a deal unless you work a job, you save enough money, and you get enough experience, and you build up your credit, and all these things that honestly took years and years and years for me to accumulate, for me to finally do my first deal. And I'm not gonna lie, guys, I felt extremely discouraged. And maybe that's you too. Maybe you're watching this video and you're like, man, I typed in the YouTube search bar, wanting to buy properties with no money, no credit, because I heard the same thing, right? And guys, again, I felt discouraged, and I was literally told by this guy that I would be laughed at out of every single bank because of who I was and my financial assets and just my lack of overall bankability. So I was discouraged, and I, like you at that point, had a couple choices, right? Like we do in life in general. My first choice, number one, was to take a job and do exactly what this commercial banker said. Take a job, work for a very long time, build on my credits, save money enough for a down payment, which the down payment could be $30,000, $40,000, $50,000, which I don't know how long that would have taken me to save, right? But I would have had to get a job, save up enough money, build up my financials, and do all these things that honestly would have taken me years before I could do my first property. Another one was to pretty much use OPM, which is other people's money. And I'm sure that's what you're thinking right now. You're thinking, well, Daniel, why don't we just do what you talk about all the time, which is for us to raise money and go out and do deals? Well, there's a problem with that. I actually brought that up in the conversation with the commercial banker, and he says, yeah, that's great, but we would actually put you in a situation where the people who bring the money would actually have to sign on the loan. And not only that, you being the managing partner and them being the passive investor, we would still ask for your personal financial statement. We would still ask for your DTI, which is your debt to income ratio. We would still pull up your credit report. And based on that, that may or may not change the terms of the deal to have it be more disadvantaged for us, or we might not even give you the loan at all. So no matter how I looked at it, I was pretty much in a hopeless situation. And of course, the third option was to quit, which I'm not gonna lie, guys, having traveled around the country and met hundreds and thousands of aspiring real estate investors, I've met my fair share of people who are, well, like, I think I'm just gonna quit. I think I'm just gonna continue to work. I think this isn't for me. I'm gonna go to day trading, or I'm gonna go to stocks, commodities, whatever. And guys, I've seen a lot of that. Well, fortunately, there is an answer. And it's an answer that we talked about and we've made tons of videos on. So fortunately for you, you can actually check out all those other resources by liking and subscribing to this video. See what I did there? Now, guys, the answer is pretty simple. It's in the title. It's owner financing. So obviously, we've talked a lot about owner financing in this channel before, but for those of you guys who don't know what owner financing is, and maybe this is the first time watching myself or Sam or any of our many other guests that we've had on this channel, but owner financing is a very, very simple concept. Now, if you were to buy a property, you would actually have to go to a bank and get a loan, right? Well, in owner financing, instead of you going to a bank, you actually have the owner almost be your bank. They're actually going to finance you just like a bank would. And you're actually completely taking the bank out of the picture. Now, guys, that is very, very relevant. Why does owner financing not involve credit? Well, it's simple. Number one, as we mentioned already, it does not involve a bank. Now, let's break down what is credit. Now, when you think of credit, you might think of the word credibility, right? And it's exactly how credit works. It's pretty much a score or a report, for that matter, that pretty much tells you how reliable are you in terms of being able to pay back loans. That's exactly what it is, right? We have a credit card. We use a credit card, right? And we swipe it, and with the promise that we eventually will pay that money back. Same thing with car loans, with student loans, and mortgages, all these things that affect our credit report or credit score. So at the end of the day, banks use credit. They pull your credit because they do one thing and one thing only. And as I mentioned in many other videos, and even in our real estate programs with our students, the banks care about one thing and one thing only, and that's mitigating risk. That's it. At the end of the day, if you are risky, they do not do business with you. And let's think about how they give out loans. If you're a doctor making $500,000 a year and you have a high net worth, you are seen as less of a risk as compared to somebody like me 6 or 7 years ago when I was talking to that lender. At the time, I had no experience in real estate. I haven't done a deal. I had no money, right? I had very horrible credit, and I had no bankability. I had no financial. So therefore, if things were to go south, I was not able to come up with the payment for the bank, as opposed to the doctor who may make $500,000 a year. I was a very high risk individual. Therefore, the bank did not want to do business with me. So what does this mean, right? What does this mean in terms of owner financing? Well, in traditional ways of doing real estate, right, we go to a bank, we get a loan, we pay for the property, and the risk is mitigated by the bank's underwriting process. Well, in owner financing, it doesn't exactly work that way. In creative and owner financing, instead of the risk being mitigated by the underwriting process, the risk is actually mitigated by collateral. Now, what do I mean by that? Well, what I mean by that is in owner financing, one of the biggest benefits is that there's flexibility. The business is done between you and the seller, and there's nobody else involved. Meaning that if the seller wanted to mitigate that risk, they can do it in many different ways besides looking at your credit report or asking even what your credit score even is. They can actually do stuff like adding collateral, which is, well, if you default on the loan or if you aren't able to pay the mortgage that month, the seller in that case has the right to take the property back. Well, you might be saying, well, Daniel, in that case, what if the seller gets the property back in really horrible condition? I've heard nightmare stories about owner financing where a seller sold the building and they get it back 5 years later and the property isn't just in complete shambles, the carpet's ripped off and the cabinets are all torn apart and there's a pack of hyenas living in every single unit. All right, I don't know, guys. I've heard story after story and what I hear just doesn't fail to surprise me, right? Well, that's actually when we move on from collateral to what is known as a contract addendum. The beautiful thing again about owner financing is the flexibility. So if I were to sell my property on owner financing and the person was a little bit of a high risk, not only would I add in collateral in terms of me getting the property back, but I would actually add addendums to the contract saying, not only do I get the property back, I get all the payments that he or she has made to me so far, and I also get to keep the down payment. But what I can also do is add an addendum saying that there is an inspection that happens every single year to make sure the property is in good terms, that it's in good graces. And that's what, again, the beautiful thing about owner financing, and that's how we can mitigate risk in an owner financing situation as compared to getting your credit pulled at the bank for the sake of, instead of them, mitigating the risk through their underwriting process. So again, guys, that's why owner financing, as you've heard in many different other videos in regards to real estate, is one of my favorite ways to acquire properties, because not only is it great for many other different reasons, like such as recession proofing and ability to scale your business, it actually does not require for you to actually get your credit pulled or for you to even say what your credit score even is. It protects you in that manner because, well, if a situation happens where you default on a bank loan, well, that actually gets put on your credit report and it damages you for the rest of your career. That does not happen necessarily in an owner financing scenario. So again, guys, I hope you enjoyed the content in this video. If you have any questions, comments, or have any insight that you want to add on top of what I already said, I encourage you to comment down below. That way we can all learn from one another. So again, guys, thank you so much for watching. Don't forget to subscribe, like, and share, and I'll see you guys in the next one.